Hello, this is Bob Howard, President of Resource Royalty, and this is our year-end review and 2022 outlook. And today I have invited an oil and gas expert named Dan Steffens to share with us the kind of macro overview of the oil and gas picture. Just to give you a little background, Dan spent many years in the oil and gas industry. He was the CFO of Hess Petroleum at one time. And then he started a research organization called Research Group in Houston, of which I am part of. And we have the pleasure of logging into this and getting his updates pretty much daily. So Dan has prepared some slides for us. So Dan will speak for a while, and then I'm going to give you some comments about our royalty portfolios. So I'd like to introduce Dan Steffens. Dan, you got it from here.
All right, thanks a lot, Bob. We'll get our standard disclaimer here. Y'all need to read that, but it basically says that we're talking about the future. So nobody knows what the future is going to be, but it's getting pretty good for oil and gas. So anyway, I updated these slides yesterday after the markets closed. So I'll show you some charts there. But anyway, I think we're at the beginning of just an overall commodity super cycle, but we're also, I think, just months away from maybe not an energy crisis, but a much, much tighter oil market, especially than what people think it is. So we'll get into that. Anyway, I think all of us realize now that this money printing by the Fed and just throwing helicopter money out there has created inflation. Then inflation is going to be hard to calm down. And I believe this has a lot to do with the commodity super cycle. As all commodities, I check the commodity markets every day, and there's all the metals and everything are going up. So cost of living is going to go up. But the oil market, it's a global market. Oil prices are set in the global market. We don't have much control since we are a net importer now. But the thing that's really causes a surge is this Omicron variant. I'm probably saying that wrong, but this latest variant of COVID is not as deadly as people thought it was going to be. And I think we're just moving on, and the economies have got to rebuild their supply chains, and that's going to require a bunch of energy. So IEA is based in Paris, France, and they comment on the global market, and EIA is in our Department of Energy, and they track things for us in the US market. But the thing is, I still get comments from people that think there's a glut of oil. Why is oil going up and the prices are going up? Well, we don't have a glut of oil. Crude oil inventories are 8% below. Gasoline, distillates, and propane, everything is below where it should be this time of year. And actually on the distillate side, diesel and home heating oil are 17% below the 5-year average. And to rebuild the U.S. supply chain problem, it's going to require a lot of diesel. So it's sure the prices. But the cold January has drained home heating fuels inventories, both natural gas and home heating oil. The OPEC cartel, which has been holding back some production, is now ramping up their production as fast as they can, and they still cannot produce up to their new quotas as they officially announce increasing 400,000 barrels a day of production, but they have been producing below their quotas for 3 or 4 months already, and over half the cartel member countries are already tapped out. So we have a very tight market, but this pandemic of fear, I think, is kind of coming to an end, and that's going to mean a lot more activity, travel, demand for fuels and that. But the one thing to remember is that as long as world population growth keeps increasing, demand for energy increases. And even the COVID virus did not slow down the Earth's population much. Last year in 2021, Earth's population grew by about 220,000 more humans per day. And in January so far, we've added another 129,000 more people per day. So it's energy is consumed by human beings, and we're adding more all the time. So getting close to 8 billion people. Anyway, so here we are in oil. It closed yesterday, 87.22. This is an 18-month chart, but I just wanted to show you that, once we got into 2021, it just has been not a straight line, but the dips are end up higher, and then we go to a new peak. So we are now $23 per barrel for West Texas Intermediate, higher than we were at pre-pandemic. Before anybody heard about COVID-19, WTI oil was trading at $64 in the fourth quarter of 2019. Then, of course, we know it dropped. There was all this stuff about it going negative. That was just on the futures market. But in the real world, oil actually was trading for like $20 a barrel for a while, and now here we are back to 87. So, and going higher. We're recording this on the 28th, and this morning it opened up another dollar higher. But we're in Team Biden's inflation world, and who knows where it's going to go. But I do believe we could see a peak to $100 oil within the next few months. Again, here are all these reasons. I won't go over it again, but a lot of the Wall Street gang and people like Goldman Sachs, JP Morgan are now saying we need $100 oil just to balance demand, bring down demand so it balances with our supply. Anyway, this is maybe the most important chart I'll show you, but this is OECD. That's the Organization of Economic Cooperation and Development. These are the consumers of oil. And it is normal for them to have right at this 30 days of consumption. I sometimes say 30 days of supply, but 30 days of consumption, probably a better term. That's considered normal. And now we are below 27 days of supply. This chart's actually a couple months old, and we're actually have moved below 27 days of supply. That cannot continue. It has to stabilize. So here is the Raymond James, just to show you these Wall Street firms have to use a price tag to value the upstream companies. And so they have to do something, and they're usually pretty conservative. So this is what they're using for 2020. So here's how actual prices averaged each quarter in 2021, and their official deal is 70. So this compares to, we're at 87 today. So we're well above this, I would say this is their forecast. It's more just what they're using to value companies. And then they think the right long-term price for oil is around 80. I think we're going to have to inflation adjust this. And I think the right price might be much closer to 90 or even 100 for a while. So I copied this slide. The head of Raymond James Banking Division, Investment Energy Loaning Group, they presented a high case. And their high case was that we would see a spike to 110, and then we stabilize back to 80 after a few quarters. But this was presented on November the 29th. So it's a couple months old, and we're already, halfway off we're up to here already. So this is coming true. Another thing I get from our members, even, and a lot of people call me or want to talk to me about, well, isn't demand for oil going down with all these EVs and everything? The short answer is absolutely not. It's going up. Actually, the transition to more wind and solar is going to require more oil. You don't build those things with the Tesla. You build them with big machinery and install them and support them with trucks and cranes and things that run on diesel. So this is a big deal. But wind and solar projects will actually increase oil demand through at least 2030. And then we might see a little dip, and I don't even believe this. But this is not just my chart. This comes from Rystad, a big research firm. IEA and Morningstar are all pretty much in agreement. We're going to increase demand for oil. So then looking out, this is from our own Department of Energy, EIA, and their projection is by 2050, yes, the green line, which is renewables, will increase rapidly. But when you add up oil, will keep increasing. Gas is the blue line, that keeps increasing. And even coal, after a slight decline for the remainder of this decade, it will have to increase because that's the only way we're going to be able to meet global energy demand. But this goes out to 2050, and so they got all the hydrocarbon fuels going up. So anyway, now switch to natural gas real quickly. There is a global shortage of natural gas. Gas prices in Europe are $30 this morning. They actually spiked all the way up to $60 per MMBTU. So, we're paying like $4 for gas, and we're paying 15 times that, up to, $60. And then also in today, this is the prices of gas in Europe. Natural gas, this is not gasoline, gas in Europe and Asia. So a lot of stuff going on here, but our storage is below where it should be for this time of year. Anyway, here's an 18-month chart like that. So we had a lot of associated gas come on with the oil wells back in 2019, and that caused a glut. Storage got filled pretty quickly, and that depressed prices through that winter. Then, if you live in Texas or Oklahoma, you remember Winter Storm Uri in February took a lot of our plants offline and had a big surge in natural gas demand. That's this little spike. And then we got to the end of the winter and we had less gas in storage than we needed. And since then, we've had this big increase. But there's a bidding war for U.S. LNG cargoes. That's liquefied natural gas. And that will continue. It actually caused some fear between the utility companies that got a bidding war, got to 630 on the October contract for natural gas, pulled back. But now we got another surge with a big winter storm coming through the Northeast. But the forecast models that I use, I am still using 350 average for 220 for 22 and 23. And I suggest you can use that or something close to that. So here's our storage report from yesterday, but natural gas and storage is 308 billion cubic feet below where it should be. That's a big deal. And I now believe we could end the winter heating season with 200 or 300 BCF below the 5-year average. And refilling storage is not an option. We have to refill storage. So that's going to keep upward pressure on the natural gas price. So here's Raymond James official gas price forecast. They're saying a little higher than what I've been using. Actually, they're saying it's going to average $4. And as of today, they're looking pretty correct. So looking good. So I'll leave that there. This is a chart of our exports. So LNG exports are the green line, and they have really spiked. In fact, we're now over 13 BCF per day, billion cubic feet per day of gas is being exported as liquefied natural gas. And then our pipeline, primarily to Mexico, we are exporting via pipeline over 8 BCF a day in gas. So a lot of demand outside of the U.S. for U.S. gas supply. So I will leave it there and turn it back to you, Bob. If anybody wants to get more information about the Energy Prospectus Group, just send me an email at energyprospectus@gmail.com, and we will give you maybe a copy of our most recent newsletter and and the way you can subscribe to our service. So, Bob, you want to take it from here?
Okay, Dan, certainly appreciate it. Go ahead and turn to my slides here. So Dan paints an extremely bullish outlook. There's no question. We've seen this before, and it's pretty well known historically what tends to happen. First of all, there is a prove it to me stage, because we've seen price run-ups before. They get new rigs drilling new wells, and then the oil price goes down. And why isn't that going to happen again? Well, the bottom line is in the past, we have had unusual developments, one being an OPEC price war that we're going to talk a little bit more, that really crushed things in 14 and 15. And that had a severe impact on the number of new wells being drilled. We've also seen that, of course, with COVID. But the net is that rising cash flows from higher commodity prices, they are having a gradual effect on asset values. And so by asset values, I'm talking especially about our royalty properties. As you know, we're beginning to see a rise in our distributions. But you kind of say to yourself, hold on a second, the average fourth quarter oil price was $71. Why aren't we seeing new highs in our distribution level? Well, in several portfolios, we are. But in a lot of the older portfolios where drilling has not been as robust, there's going to be a catch-up period. And this has a lot to do with rig count. So rig count is now increasing, but it's not back to the levels where we were pre-pandemic. Obviously, oil prices are, and they're over that, as Dan points out. But what happens now is new wells need to be drilled. And what will cause that? Well, at some point, the companies just cannot take not taking advantage. There's $50 profit margin in oil, maybe even more in some cases right here. But we've had this whole ESG, fossil fuels is evil movement, And this has really kept the institutions out of the market. It's the big state pension plans and so forth that fund a lot of this through private equity, and they're not in the market. And so the net is that prices of actual underlying values have not really increased a great deal, even though the commodity price has risen. So it's our experience that you need 6 to 12 months or longer of price stability for investors to regain confidence after this huge decline. And then, as I mentioned, the ESG, the environmental, social, and governance movement has really limited the funding of oil and gas related investments. I think they will be back because the profits are too great. And so in essence, you've had a lack of institutional capital due to these ESG movements. So as we move on to the next slide, I just want to remind you, this is a little longer term chart of the price of oil. And everything was going fine back in 12, 13, 14, until OPEC decided that they wanted to outproduce or flood the world with oil. Oil declined from about 105 down to $27 over a period of time there. And that really had a severe impact on drilling of new wells. And then obviously things were rebuilding, and then we had COVID. As you can see from this chart, we had a sharp drop, but it's now improving. So on the next slide, we can see that our rig count, and click the next slide. Okay. Now, this is the number of drilling rigs working over the last 10 years. So I want you to notice up there where it says OPEC price war, there were over 1,000 drilling rigs drilling new wells at that time. We went all the way down to 220 at the very bottom. So that was a enormously severe decline. And then you can kind of say to yourself, hold on a second, why didn't we rebound to 1,000 as oil was back up to $65 or $70 a barrel in 2018 and 19? There began to be a mentality on Wall Street amongst the big oil companies that they needed to operate from free cash flow. In other words, they were just going to take the profitability of each year, drill from that money, and send the rest back in dividends. So what you've seen here in the last year is enormous dividend declarations by Devon and Marathon and EOG and other large companies, and they've chosen to return more money to shareholders. And a lot of this has to do with this ESG movement. So why not reward shareholders and see if they can maintain their reserves without drilling as many new wells? Well, rig count is rising, but it's still at 481 as compared to a high of about 800 back in 2019. Now, history says that this will change. So let's move on. Move on to the next slide.
Okay. Yep. All right.
So commodity prices have recovered. The fundamentals are positive, and they should maintain a higher price environment. The underlying property values tend to rise as stability returns, which we're seeing now. And it looks like the beginning of a new commodity cycle. And a lot of this, of course, has to do, all commodity cycles are the same. They are the result of underinvestment in exploration and mining of metals, whatever it may be. So we have seen drastic underinvestment of drilling. We're going to wind up in a much higher oil and gas environment here, which we've already seen kind of the tip of the iceberg. And as a net result, we believe that there will be more wells drilled because it's always happened that way. Companies like to make profits, and the profits are big now. And so in a net, we're still in this lag period. It's not the time to be a seller of these properties, but it's time to be a buyer. So we're buying assets in this environment. They are generating much better returns than we saw earlier. That kind of concludes my remarks, but I'm happy have further discussion, so feel free to email me or give me a call directly here at our Dallas office. So thank you, Dan, and thank you all for listening to our year-end update.